Okay. So, one of the things that is very interesting is what actually creates a better investment over time. And should you be focusing on dividends? Should you be focusing on free cash flow? And I am joined, as always, by my good friend, colleague, co author, Professor Mark Guttner of Rutgers. Mark, how are you? Hey, Mark. One of these days I'm going to actually figure out how this works. You would think, having sat on this side of a camera as many times as I have, that I would actually figure this whole thing out, but apparently I just don't get the cues.
Yeah,
How are you?
I'm pretty good. I guess you need a little something on your screen to tell you when to get going.
Yeah, I mean, I guess that's one of the issues. The other is I have so many screens, and I'm always looking at these
Yeah.
things in the middle of the trading day as well. But you were talking just before we came on today about something that I think there's these ebbs and flows of topics that people talk about. What actually helps generate superior risk-adjusted rates of return if you're an equity investor? Once upon a time, people would invest in stocks because they were hoping to get dividends, right? So, if you go back a century, people could invest in bonds, they could invest in stocks. One of the important reasons that people invested in stocks was because commonly they paid dividends. You bought a share of a business so that you could receive on a regular basis a share of that company's profits. The issue with this, there's a couple of them, but some of the issues include tax issues. So there was double taxation problems with dividends. In other words, corporate income taxes, and then there would be taxes paid by the recipients of dividends.
Yeah.
A lot of companies are fast-growing companies, and they might be reinvesting, or they may not even be profitable yet. So dividends kind of, while once very important, I think, to investors, have not really been the focus for a long time. The S&P, what's the dividend yield on the S&P right now?
I'm going to guess a percent and a half, percent point
Let's take a
four.
look. We'll look at SPY and just assume that that was your proxy. One. It's not even 1.1. It's 1.08%
Oh, geez.
right now.
I
If you
know. I
can,
knew it
if you
was
can.
at historic lows. Well, companies do prefer the share repurchase, and we shouldn't be surprised with that because if a company pays a dividend, the share price goes down, right, by the amount of the dividend. So um, that doesn't happen if they return money to shareholders through a share repurchase. That doesn't have an impact on the price of the stock. So if you're a manager and get paid, at least in part, on stock options, you prefer a share
Mm.
repurchase versus but versus paying a dividend. Uh, all other things equal. And one of the things I think is rather interesting is, share repurchases were not something we did a lot in this country. In fact, they were illegal all the way up till something like 1981 or 1982. The only way a company could return money to shareholders was through a dividend. I think the idea there was that everybody gets treated exactly the same, and um, certainly the Congress likes that because they do get that double tax. But there is a bit of a double tax on a share repurchase because if you bought a stock at 20 and then it goes to 50 and you decide to tender your shares when they're repurchasing, you're paying a capital gain, right? So the company paid its income tax. The investor pays a capital gain. But the nice thing about share repurchases from the standpoint of the shareholder is that they get to decide when they get the cash flow. And they get to decide when they're going to pay a capital gains tax. So,
Yeah, that's a great point because, of course, if you have a diversified portfolio of stocks, maybe you have 30, 40, 50 stocks in your portfolio, it would be really nice if all of them rose in lockstep with one another, but that's not necessarily how it goes. And unless you're maybe the world's best stock picker, it's almost never the way it goes.
Yeah.
So the ability to time when you realize gains is really helpful because if you can make that concurrent with the realization of losses, and we're coming into the tail end of the year. This is actually a really relevant conversation at this time of year. Here we are in November, and what do we have people doing? Tax loss harvesting. What are you doing when you're tax loss harvesting? You are realizing losses so that you have the ability then to also realize gains without a really harmful tax impact. And the thing is, this is an important element for investors to contemplate because, the value of your dollars is constantly eroding through time as a function of inflation. But the way capital gains work, you don't get to make any adjustments or accommodations for that. So if the cost of a basket of goods that you would purchase with your dollars 5 years ago is now 30 or 40% higher than it was then, and you have stocks that have appreciated by 40%, you don't get to say, well, actually, in real terms, my money hasn't actually grown at all.
Yeah.
No, in fact, you will pay you'll pay taxes on those gains, and you'll actually end up with less money in real terms than you invested initially. But you've been doing a little bit of work on the nature of buybacks and what the performance implications could be for the relevant companies and comparing it to some other things. So what have you got for us?
Okay. Was that one that I'm supposed to put up? I'll put it up.
No, I think it's up now. It looks like it.
I don't see it on my screen.
I see.
Oh, let me
well,
look
they're
at
displaying
this.
it to the screen. Yeah.
It's not letting me click on it. So
I see buybacks have been the most tax efficient capital return factor.
See, I have what's big on my screen is your SPY exhibit you put up from Bloomberg.
Oh, my screen share?
Yeah. Is that taking?
I can probably stop sharing that, and let's see what happens when I stop sharing.
That's a little bit easier for me to see. So which is fine. I stumbled upon this, I don't know, a week or two ago. And one of the things I always like to tell my students is to oftentimes not overthink things. And if you can find strategies that have tailwinds, then, as an institution, we believe in the efficient market hypothesis. So we have, a bias towards passive investing. And so Bank of America did this little chart here, and they showed that stocks with the most buybacks outperformed the dividend aristocrats. The dividend aristocrats are companies that grow their dividends a little bit every year, year in out. And I think they've done it for at least 20 years or at least 30 years. I don't remember what the exact definition is, but it's companies that pay dividends every year, and they typically go up a little bit. Then you got the S&P 500 comes in third, and there's simply stocks that pay high dividends comes in fourth. Now, the dividend aristocrats are ones that pay good, consistent dividends, but also have a high coverage, right? That they have plenty of earnings. There are companies like REITs that pay high dividends, but they're paying out all their income. And so that may not be the best thing to do. And I thought that was, this chart is rather interesting because when I see something like this, I always I ask the question of why. And one of the things, who are the big buybacks these days? It's the large cap tech, and it's companies that are more mature. So they're returning companies to shareholders. They're more steady. And that may be one of the reasons why they're outperforming, not just the fact that the share buyback might be a single signal that the company's making a pile of money. And they don't have anything to do with it. Apple is a great example of that, right? They make so much money. that they're like, they're drowning, in cash, so they've got to give it back. They got to, and the best way for them to do that is with a share repurchase.
Could I ask some questions about the methodology, which you may or may not know for this study? The first is, were they looking at the companies that were buying the most amount of stock in dollar terms as a percentage of the market capitalization of the underlying business? What was the methodology? Because I'm sure there's a lot of companies with a lot of buybacks. Or were they just basically aggregating all companies that had stock repurchase programs in place and saying that if you did, then you landed in this bucket, and if you didn't, you would not?
Yeah, I don't know. My guess, if I did this study, I would have had some kind of, I don't know if they include all companies that made buybacks, or they had some minimum level of buybacks, relative to the market value of their stock. That I don't remember.
So the reason I ask that question is because my intuition about the outperformance comes from a couple possibilities, right? So one of those possibilities you just alluded to, which is that companies that have big buyback programs, generally speaking, have very good and often growing free cash flow. That is, that you are trying, the question, and oftentimes they go out of their way to emphasize we are returning cash to shareholders. That's how they describe buybacks in many cases, which is because of course if you paid a dividend, then indeed you are giving cash to shareholders. If you buy the shares, you are not giving cash to shareholders, but you are deploying cash on behalf of shareholders to create capital appreciation in lieu of a cash payment.
Yeah, that's true.
And circumstances where that would be true would include companies that have very high rates of free cash flow and free cash flow growth. The other thing that is interesting in this case is that very frequently companies that have these types of buybacks, or at least recently this has been true, these have also often been companies that are experiencing higher rates of growth. These are also companies that have a tendency to issue a lot of employee equity-linked compensation grants.
Mm-hmm.
So whether it's in the form of restricted stock or whether it is in the form of employee stock options. So that creates, some might argue that isn't it a little bit of a conflict of interest for management that has been issued a number of stock option grants to think about their capital return and buyback policy in a manner that might increase the share price. On the other hand, of course, that's what every shareholder wants. Yeah. What are your thoughts on that?
No, it makes sense for them to do what they do. As I mentioned, I don't think of it in terms of share repurchases raising share prices. I think more of it in terms of it avoiding a loss, or avoiding a drop in the share price, which is what the dividend does. And nothing, you can show mathematically that nothing should happen to a share price if they simply take the cash out of the company's bank account and drop it into the bank account of shareholders. That should not create value. It's because it's just you're moving money from the left pocket to the right pocket. But they don't suffer the drop in the share price that comes with a dividend, and therefore their options are worth more. A company, go look at any company, and you know this from the option pricing models. You put in a high dividend yield, and that will lower the price of a dividend, right? Because of
a call option.
Option. Yeah,
mm-hmm.
That's right.
Mm-hmm.
So
if you increase the dividend, you reduce the forward. Right? So the forward price of a stock is a function of, the anticipated growth and risk-free rates, less distributions being made mm-hmm. by that stock between now and then. Yeah. So you have to pull out the net present value of distributions, which makes perfect sense. Mm-hmm. If you can think about it from a bond perspective, if you had a zero coupon bond or something like this, you had something where all of the money gets paid at the end, then it's going to incorporate the rate of return that investment provides whereas one that is making regular payments is not going to incorporate that
Yeah.
at the sort of the terminal value.
Yeah, there's another thing that's going on here, and I'd really like to look at the list of stocks that they had sort of year in, year out. One of the stocks I talk about in my classes is Home Depot.
Mm.
And Home Depot is an interesting company because they buy back shares, but they often buy back more shares than profits they have. Like that, they'll spend more on their buyback than profits. And the reason why is their share price and the value of the company is going up. And so, in order to keep their debt to equity ratio constant in market value terms, they will go out and they'll actually borrow some money and use that money to buy back stock. So you go look at over, especially since 2009, companies like Home Depot, the amount of debt outstanding kind of marches up every year. And they are using that money to buy back stock.
So this is Home Depot and the state of their current buyback program. And I will also just take a look here. So we can. This is sort of that consolidated financial view that we can see right here. And what Mark was talking about, which is the total debt, that's this line right here.
Yeah.
You can see how that
goes up every
does
year.
indeed. Yeah, it does. It sort of grows somewhat steadily. If we look down at this line down here, this is indicative of the free cash flow that the company is experiencing. And now let's just go back here to the buybacks. And so the target amount, and they still have a lot remaining, $15 billion. When was this initiated? I thought that was on the screen. So the announcement date was 8/15. So a $15 billion buyback. Now, here's something that's interesting. I don't know if you've studied this at all. You know, if we think about famous investors, hard to come up with one more famous than Warren Buffett. And Warren Buffett has very periodically indicated that he would repurchase Berkshire's own shares. Not a common thing, but he has sort of a standard litmus test that he employs to do this. And effectively, you know, he's always looking at the value of the businesses that he does hold, because he's a perpetual. I should actually say Berkshire Hathaway now because he's retired, is a perpetual acquirer of businesses, and of course they're going to look at the value by their assessment of their own stock relative to the other stocks that they might otherwise purchase.
Yeah.
In your experience, when you look at buyback programs, has it seemed as if management has done a decent job either with timing those repurchases? Do they not exercise discretion about those purchases? My sense of it is that the jury's kind of out on that one. I mean, Warren Buffett always had a valuation of the underpinning businesses, kind of like a book value idea in his mind. Yeah. I buy it here, but I will not buy it there. I don't get that sense for most buyback programs. They seem to be more systematic and not discretionary. Do you have any thoughts on that?
I think that's probably right, especially with these mega cap companies, because they don't want to disrupt market trading, so they don't want to come in and buy $1 billion worth in a week or something. You know, they want to buy a little bit, just sort of day in, day out, and return cash to shareholders that way. So I don't think there's a market timing thing going on where, oh, the stock got slammed today. Let's step in and buy some extra shares. I don't think that's what's going on.
Yeah, well, I think also there's probably some restrictions. Interesting, you know, Home Depot's current authorization, what they still have remaining on the existing plan, is more than 3% of the current market capitalization of the company.
Yeah.
And it's well supported by their free cash flow. That was a comment you had made with respect to the dividend aristocrats versus just high dividend payers, which is how well covered are these. I mean, an example of one that did not appear to be necessarily well covered, but was a very judicious, shall we say, return of cash, was when Apple took on massive amounts of debt when rates were exceptionally low.
Yeah.
And, they had a massive amount of cash, and they said, this is not an efficient, our capital structure is inefficient. This is not what we should be doing. So they started buying back their own stock, and they also issued a lot of very long-term debt at very favorable rates.
Yes, they should.
To repurchase their shares. And this is something else that I think people should think about as they look at buyback programs, which is, what is the dynamics of the world we live in? Are there rate dynamics that management should, assuming they have the financial flexibility to do so, try to take advantage of opportunistically, the way Apple's management did when they had huge amounts of excess cash, and they said, well, if it's not sensible for us to carry all of this cash because basically rates are so low, wouldn't we be better off borrowing money at these obscenely low rates and returning it? And they were right about that.
Yeah.
Of course. Do you happen to know, this was going on a few years ago, because I think this is important for people to think about, that there was actually companies' profits would show the markdown in the value of their own debt as a potential. In other words, that the logic of that was, we issued $50 billion of debt, maybe high duration. Now the value of that debt in the open market is $35 billion because, long-term rates have risen so sharply. What's the accounting for that as you look to value a business, particularly for those businesses, so they can repurchase shares? You can also,
repurchase debt.
Right?
Yeah. Well, when you do an enterprise value calculation, you're supposed to use, the market value of the equity and the market value of the debt. It's just that most people use the book value of the debt because, for the most part, if you're dealing with bonds that are rated, let's say, BB and higher, they trade pretty close to par. So the extra work of trying to figure out, it's trading at 96 cents on the dollar or 104 cents on the dollar or something, it's not necessarily worth the effort. And especially, now this is easier to do if you have a Bloomberg, because Bloomberg prices it all for you. But what if you're a guy like me who doesn't have a Bloomberg, and I wanted to figure out what the enterprise value is? I'll just look at the debt, and then I'll look at the coupons, and I'll say, well, the coupons are pretty close to market, close enough for me. I might make a little adjustment to the price. If, let's say, they got a bunch of 2% coupon debt in a world where new bonds would need a 6% coupon to get sold, then I might make an adjustment there.
Well, here's what I was sort of referring to specifically. What we're looking at right here are some Apple 2050 265 bonds. And as you can see, these things right now are trading at 63, 64. And you can see that, as you would expect, a bond that has 25 years to go, that it actually moves around quite a decent bit.
Yeah.
It is not that Apple's creditworthiness has changed materially since 2 years ago in 2023. Instead, the volatility that you are seeing in the price of this bond is more a function of rates than likely anything else. Although, actually, there was let me see, I'm going to look right. No, see, here's a perfect example. If we look in this area right here, right? So equities got nailed at that time because that was the post-Liberation Day swoon for equities. And we can see that the value of this bond changed relatively little. Now, if you think about the capital structure, maybe you could speak to this a little bit, that, as economic risks increase, especially if they increase dramatically, that in theory that should have some implications for the value of all of the pieces of the cap structure of a business if you view that to be an economic risk. But it doesn't seem like that was the case here.
No, if you go up to the top there, you'll see that the 61.4 BP versus an equal maturity treasury. So what you
Hmm.
want to do if you're trying to get an idea of has the
That's up here,
riskiness
by the way.
changed? I don't know if you can create a chart of that spread. That's the credit spread. That's the extra yield you
Hmm.
get over treasuries by owning a corporate bond that has, well, de minimis default risk. It does have a little bit of default risk, and it has a little bit of a tax number in there too. So um, Apple stock is taxable at the state level, right? But treasuries are not, right? Because
Hmm.
uh, interesting dynamic there. You lend the U.S. government money, and they pay you some interest, and then they say thanks for that, and then they charge you some income tax on the money they just handed you. Yet, if you live in any state, they're not subject to state income tax. So there's a little bit of tax effect in there, but there's also a little bit of credit risk. So I don't know if you can chart that 61.4 somehow
Let me
through
see if
time,
I
and then
can.
you can see if it's really changed much. And I'm going to guess that it has not.
Yeah, I don't. I,
So
I don't think it has. I'm trying to remember.
how you
I'm
can
gonna
do
have to
that?
think about that for a second. Well, the way I usually do this and because actually I've never really looked at the creditworthiness of Apple. The way I usually do it is by looking at the CDS
Hmm.
for um, because usually when I'm thinking about this credit spread, I'm usually thinking about it in terms of businesses that have a higher
Yeah.
default risk. So I will typically do this, which
Yeah.
is look at the credit default swaps,
Yep. That's fine too.
which actually kind of interesting. Look at that. I
Yeah.
wonder what that's all about.
It's it's not much.
I mean, this is still nothing,
Yeah.
right? So this is just to put things in perspective up here, folks, for people who have not looked at this kind of thing before. So this is um,
20-year CDS.
on this is senior. This is 20-year credit default swap, and you can see that this isn't basis points,
Yeah. I think
right? So as you're thinking about this, you can see that the credit default risk in Apple over a long period of time is exceptionally low. This is fairly comparable, by the way, to the numbers that we were seeing for Meta. So Meta only recently did credit default swaps even begin to trade in Meta because Meta, up until very, very recently, has never had net debt.
yeah.
It's always had net cash on the
Yeah.
balance sheet, and only recently did that situation invert. And so once that situation did invert, and by the way, their net debt is de minimis relative to the size of their balance sheet.
Yeah.
Meta is a whatever,
I'm,
what is it, a $2 trillion company now,
yeah.
and their net debt's like 10 billion. I was talking about this I think a week ago or so. Yeah, it's not even. So we've got net debt of about $6.5 billion on a $1.6 trillion business.
Yeah.
Um,
I would.
really
I was going to say I would
meaningless.
suggest that little bouncing around of the CDS spread on the last chart
Hmm.
probably has everything to do with that tightening of liquidity we talked about last week in the banking
Oh
system.
yeah, good point.
Because
Yes,
it makes it harder for or more expensive for the market makers to make market.
that's right, and that's why they did that repo that you were
Yeah,
talking about a week ago.
yeah. So
Hmm.
that I'm gonna I would be I would
Oh,
be
look at
90%
that.
sure that's the reason why we saw that little wiggle there.
Yeah, when was the government? When did the maybe Jay or somebody can just double check when did the government shutdown officially begin?
I want to say it was
Um,
about 70 days ago,
that many? I don't think it was
maybe.
even
I don't know. I thought they were saying it was the
um,
longest.
October 1st.
Oh,
So
okay.
that happened. Yeah, that happened. So the shutdown occurred here,
So 30,
and
45
that
days.
and then the repo that you mentioned was relatively recent.
Yeah,
But there would have been a little bit of a lag
before the
for the
need.
money, yeah, for the money to flow into one part of the system, but not back out again, so that it was actually landing on, the demand deposits, for example. That's a really good point. It's interesting because in situations like this, we find ourselves talking about things that you rarely talk about because it's just not an issue. Like you don't start talking about the ways in which a government shutdown impacts money and credit that often, because they're relatively infrequent, and even when they have occurred, relatively short-lived.
Yeah.
But this was the longest one in history, or is, right?
Yeah.
So the implications become more important. What do you think are the investment takeaways then for investors who are saying, okay, well, I want to try to capitalize on the long-term outperformance of buybacks? Is this the kind of a screen that you might try to affect?
Yeah, you might
and just say, okay,
you might do that, or search for an ETF that focuses on companies that buy back shares, and they might
is there
have
such a
some.
thing? I suppose there would be.
I know that there used to be one called the Float Shrink Fund, but I'm not sure that company that was doing it is still around. But there might be an
Trim
index.
Float Shrink ETF.
Is it still in existence?
Yeah, well, let's see here. Let's just try ETFs focusing on buybacks. Let me see here. Let me get social. Make sure that I've got that up as well. I do, yes. Monday Morning Quarterback actually said, is there a study that monitors or measures buybacks versus employee stock compensation? Is there a study that monitors or measures buybacks versus stock comp? So, I mean, I guess it's interesting because the types of companies that initiate buybacks are also very often the types of businesses, like tech companies, that tend to offer larger slugs of incentive-based compensation in any case, right, Mark? So there is always going to be a sort of a natural correlation. I would add one thing. I don't think anybody does this anymore, but in the late 90s and into like 2000, 2001, there was a period of time when a number of companies were selling puts on their own stock. And they were doing that to hedge their stock option grant to employees. Right?
Okay.
So, and you'd say to yourself, well, wait a minute. That's an interesting dynamic. So companies are selling strangles effectively then on their own stock, because they're giving stock option grants to employees, so they're short calls, and then they're selling puts on their own stock. And you'd say, well, how is one a hedge for the other? And it seems now, believe it or not, I see you shaking your head. You're like, that seems a little crazy.
I don't know.
But actually, believe it or not, there was a rationale.
Okay.
It's not really common now. But what was that rationale? And you can imagine you're sitting around the conference room table, and people are saying, okay, we're talking about our, you've got the treasurer and the CFO in there and the CEO, and you're working through all of these things, and someone says, the dilutive effect of our equity stock compensation plan is 10%.
Mm-hmm.
Okay. And so what does that mean for people watching or for people who are an investor? Basically, it means that the fully diluted value of the business is going to, for you as a shareholder, is going to go down because you're being diluted by all of these employee stock option grants. So when people trade call options in the secondary market, it has no impact on you.
Yeah.
But if the company starts issuing grants, that means that the share count will increase.
Yeah.
And when that happens, your percentage of the business goes down. So somebody says, I got a great idea. And someone says, well, we have to buy back the stock so that it's non-dilutive.
Mm-hmm.
So they're saying, okay, we give option grants to our employees, and then with our free cash flow, we are going to repurchase our shares so that at the very least it's non-dilutive. And you can see there was like a big harumph around the conference room. And then somebody says, well, wait a minute. I don't like that because, what if we want to deploy that cash for other purposes? Now we're effectively compelled. And what if we don't have the excess cash at that time to do it? And so somebody says, well, I got a good idea. Why don't we sell puts? Because selling puts is going to generate cash. So rather than expending cash, we are now generating cash. And the worst thing that happens is the stock price falls and we end up repurchasing our stock, which is what we were just saying we were going to do anyway.
Yeah.
Only we'll be repurchasing it at a lower price. Now everybody around the table, oh, no, that sounds great. We'll do that. I say this kind of casually and lightly as if, people are just willy-nilly throwing ideas around the boardroom table. It isn't quite like that, of course. But that's the elevator pitch on why selling puts might have seemed like a good idea as an offset to dilutive employee stock option grants. Now, of course, we experienced the tech wreck, and the downside of plans like this quickly revealed themselves. Because a lot of people, selling puts can be a very attractive way to generate options premiums. And if you have a sort of a steady bull market, whether you're a retail investor, an institutional investor, or a corporation issuing puts on your own stock, this might seem appealing until you have a severe downdraft.
Well,
and then the weaknesses reveal themselves.
It's one of those things about selling puts. Now, if they were going to, they issue a bunch of options, and when people come in and exercise those options, let's say $1 billion comes in, right? Because the option's at $60 and now the stock's at 100, so they want to buy it at 60, they sell it at 100. The difference is their compensation. Now, if the company says, oh, okay, we need to buy back $1 billion of stock, they could just go into the marketplace, buy back $1 billion worth of stock, and reduce the amount of dilution that they suffer. Now, if they're going to do the same thing and commit $1 billion of cash and let's say take the number of shares times the strike price equals $1 billion, and that's, let's say, a few bucks, $4 or $5 below the current price. Yeah, they're hoping to buy the dip, right? Mm-hmm. But if they get a little crazy and maybe hire the risk manager of Silicon Valley Bank, they might be tempted to go sell $2 billion worth of options because, hey, we'll collect twice as much premium. And so it's all a matter of risk management, of whether or not it's a good idea or not. I wouldn't call it a hedge.
No, it's definitely not a hedge.
So that's why I shake my head. But
it's definitely not a hedge. But it was. One can see how. Yeah. There's always there is some reason to it. It's not without any rhyme or reason, but it definitely exhibits some flaws. I happen to have on my screen right now, ticker PKW, Papa Kilo Whiskey. This is the Invesco buyback ETF. I'm actually going to do a quick comparison. That looks like it's
performed pretty well.
Yeah, I'm actually going to do a quick comparison. Let's just do a quick comparison of this one versus the S&P. Let's just do year to date. We're going to look at it and see how it's done year to date. I got to normalize this then. And so it looks like it was actually outperforming, and quite substantially through early September. It was actually outperforming the S&P by almost 4.5% from the last trading day of 2024 through the first trading day of September. From that day until the end of October, it gave away more than 8.5% of that outperformance. So it underperformed the S&P by 8.5% in about 2 months, maybe a little bit less. So my immediate question is going to be, okay, why is that? And let's just take a look at the constituent stocks in here and see what could be going, what may have gone wrong. What sticks out in here? Well, some of these things are really low beta. Kroger.
Yeah.
Right? So that's a supermarket. That thing's not moving. MetLife. That thing's not moving. Wells Fargo, actually, I made the point recently that on a relative basis, I kind of felt like Wells Fargo might be appealing. Sorry, I should have shut that off. Was appealing relative to some of the other big money center banks. And the reason I offered was that, number one, it trades cheaper.
Mm-hmm.
And number two, their balance sheet really has very little junk on it. Because when they got into all that trouble for opening up accounts, one of the restrictions that was imposed upon them is that they were not allowed to grow their business. And if you take a look at things like HELOCs and some other, I'm not going to say that's the riskier end necessarily, but let's just say that, that's going to be an area of potential exposure. Their balance sheet in those areas actually declined as a function of the restrictions that were imposed on them over time. Mm-hmm. And so if you kind of imagine that, are we coming to, where are we in the credit cycle? And actually, I'm going to ask you that question next. But if you figure, we might be getting to the latter stages of the consumer credit cycle, and this is an area where they have relatively less exposure, this means that to the extent that they're going to be able to pick and choose, they're in a relatively good position. And I'm assuming, I don't know, but I'm assuming that the company's troubles are, that they've kind of cleaned themselves up. They've had a number of years to do this. And so my thinking was that, hey, maybe Wells Fargo actually, on a relative basis, because it trades cheaper than their comps, and because they can't really have gotten engaged, as consumer credit has deteriorated, they can't really, because they were restricted, have gotten excess exposure to it, that actually positions them well. What are your thoughts?
Oh, I think that's exactly right. They were not aggressively in the marketplace trying to make loans and attract depositors because they were restricted on doing so. They had limits on growth. And so why not, if you're in that world, why go down the risk spectrum? Why not use that as an opportunity to just improve your balance sheet? And and you get to really spend more time deciding who you're going to lend money to. Your asset writing strategy can focus more on quality than, because what banks often do, they always do this, they're making a trade-off between the probability that a company is going to default versus the rate of interest they get to charge and the fees on the loans they originate. And so to the extent that they're focusing on companies that I would guess in that triple B to single A range, maybe some double B names. I'm going to guess their balance sheet is probably in better shape than everybody else in the U.S. That would be my guess without having, access to their exact balance sheet.
Yeah, I mean, I think this is when you're dealing with institutions of this scale scope. I think that sometimes we do have to rely a little bit on heuristics, a little bit on intuition, simply because there's a lot to break down in financial institutions of this size. It is virtually an impossible exercise. You spent a number of years working in banking yourself, but let's just put a little bit of scale scope perspective on this, if we may. In these cases, we are dealing with institutions, in the case of Wells Fargo, that has $2 trillion worth of assets. How much expertise can one truly have understanding what is and isn't on that balance sheet?
Yeah.
We have to use, we sort of have to use common sense. We kind of have to look at, behaviors of big baskets of assets and liabilities through time to make generalizations about them. I remember, Mark, many years ago when you and I worked together, and the company we worked for was doing an analysis of American Airlines operating in bankruptcy. And I think we had 5 credit analysts working on it at the time.
Yeah.
This is in our CRT days.
Yeah.
And I remember that those guys sent us spreadsheets, and they were detailed. I mean, they had like the serial numbers of tugs that were at the gates. I mean, it was unbelievable. I mean, when I saw how much work they had done, I thought, I wouldn't even, and this was before large language models or any other kind of AI, compiling that kind of data back then. When was this? This is like 13 years ago, right? Something like that, 12, 13 years ago. Compiling that kind of data with that kind of, detail, it seemed unfathomable to me. I thought, how on earth did you guys get all of this stuff? I mean, it was just amazing. This is the challenge and American Airlines is no Wells Fargo in terms of its size.
It's much simpler.
Yeah. So this is one of those situations where one definitely has to sort of use these rules of thumb. What are some other potential takeaways you think from this analysis that investors might use? Let's see what else is
to
on
me,
here,
it's
by
like
the
keep
way.
it simple. We're oftentimes encouraged to trade a lot, and for most people where investing is not their profession, it makes a lot of sense to find something that you can invest in that is going to give you the rate of return of the S&P 500 with perhaps a little bit of alpha. And so buying stocks that have heavy share repurchase makes a lot of sense. It might be a nice alternative to buying SPY or what is it? Vanguard's VNO.
Yeah, that sounds right. Let me see here. That's their low cost.
Their ETF. Yeah,
That's Vornado. VOO, I think it is, right? Is that right?
Vanguard.
VOO? Yes, VOO.
VOO. Okay.
Going by memory.
Yeah. So
VNO is
that's a nice alternative because it's, that's where you spend your challenges. Can I find a strategy that will, since I'm going to be a buy and hold investor, holding that position for, perhaps decades, it has a big wealth impact if you make 13% instead of 11% or something like that, 12 instead of 10. Compound that extra 2% for 20 years. That has a huge impact on your future wealth.
So what I'm looking at here, this is a chart of the 30-day historical, that is to say the realized volatility of PKW, which is the buyback ETF, relative to the S&P. Now, we already saw the constituents that were in it. A lot of these are big, recognizable names. I actually didn't know what I would expect to see here. I wondered if maybe the volatility of the buyback stocks might be lower than it was for the S&P because you're dealing, generally speaking, with companies that have a lot of excess free cash flow. Therefore, I thought maybe they've got less leverage on the balance sheet. I thought that also the buybacks might stabilize the stock
Price
somewhat
action?
because you have the price action. You might have a lot of open market activities and purchases, which could potentially have an impact. But that proves not to be the case. It does look like this is slightly higher volatility. That may account for that relative performance deficit that we have seen more recently, because there were a number of stocks that were very high flying in the earlier parts of the year that in more recent months started to get chopped up a little bit more. Meta would be actually a good example of this. They said, look, we're going to be making bigger CapEx investments after earnings. Earnings numbers were good, but that hurt the stock, and of course that increased the volatility. Let's see what we have here. So Tucker D. Dog says, no one holding for 20 years from now. Older gen not going to be around. Younger gen doesn't have the attention span. Ha ha ha.
Yeah.
Older generation. Yeah. Well, we're hoping we're going to be around.
Yeah,
right?
I'm hoping to be around. But yeah, point well taken.
Yeah, it's a fair point. And Monday Morning Quarterback earlier in this conversation made the observation that bigger incentive for buybacks to avoid double taxation, keeping the float from growing due to stock comp, higher cap rates, and Affordable Care Act surcharges. Yeah, that's actually, this is interesting because the Affordable Care Act and the incremental subsidies are a big portion of the reason. It's those temporary subsidies for the Affordable Care Act, also known as Obamacare, that was one of the big issues that was causing this huge spat in Congress.
Yeah.
Should they authorize an extension of these supposedly temporary subsidies? I don't know if it was actually Milton Friedman who said it, but it's a great quote, and I rather like. Monday Morning Quarterback is also saying, without a Bloomberg, how can we access CDS? That's a very good question. This is one of those. I apologize for this because, admittedly, Mark used a Bloomberg for a long time. I'm sure you have access to some at the university, but maybe you don't have one sitting in your office at all times.
No, I don't
probably
have one in my office.
A Bloomberg lab. But I actually don't know, but I we can probably look into this and try to find out. This is just how I've been looking at things for so long. So I have never tried to get CDS from another source, but it might be available on something like TradingView. I don't know. Certainly worth a look. Now, on this Affordable Care Act surcharges issue, which you also brought up, this is something that I think a lot of people don't recognize. In high tax jurisdictions, you're already being subject to federal income tax, but those are not minor. I can't remember what the surcharge is. It's like 3-something%, I think, on top of everything else. And then if you happen to be subject to AMT, right? So you don't have the ability to get offsets for all of these things. The effective tax rate for people in the top bracket in the highest tax jurisdictions is considerable.
Yeah.
In the state of California, all in, it's more than 50%. I was looking just at one of my regular pay stubs recently, and I I get 52 cents. 52 cents on the dollar.
Right.
Is what I get out of my paycheck.
Yeah.
Each week, or whenever it is that I get it. I mean, probably to avoid depressing myself, I don't look at it all that often. And it's not like the things on there are going to change a whole lot, and it's not like I have much control over them anyway.
Mm-hmm.
But that's pretty shocking. And then, of course, when you consider that when you go out and spend your money, you often are subject to sales taxes and things like that. And so when you put it all together, most of the money that I make, that the biggest expense I pay is taxes. Most of my money goes to taxes. Sales taxes, income taxes, and various other things that get yanked out, but that's where most of it goes. So your Monday Morning Quarterback is right. I don't think about the ACA surcharges, but I was just talking to somebody a week ago who made that exact comment. We were just talking about some of the planning and trading and different things that he was doing, and he specifically brought them up. They were material enough that they were affecting his own decision making. So I think that is an important conversation. And with respect to the temporary subsidies, and this is what I was about to say. Milton Friedman, I think, is the one who's attributed with saying this. He said that there is nothing so permanent as a temporary government program.
That's for sure.
Again, I thought that was a great quote. And that was attributed to him. I don't remember ever seeing a video when he actually said that. Maybe I'll dig one up. He had a lot of very good one-liners, I thought. He was a funny guy.
Let's talk about
Mark,
last
we
thing.
have 5 minutes left, so why don't you tell us some other things to look at here. I'm going to just be quiet for a second.
We were going to talk about transportation and UPS and FedEx, but let's leave that for next week. Instead, let's just go to the last slide, or I can share it that I put up that we would talk to, and that is the MNAV for MicroStrategy. So
yes.
So that's kind of a new thing now, because the MNAV back in 2023 was actually slightly less than 1.0. That means the market cap of the stock was slightly less than the value of the underlying Bitcoin held on the balance sheet.
I'm not seeing that chart, so
it would be the last one. It starts with the number 6. I can put it up if you need.
No, there we go. Oh, here we are.
So you're over there on the left-hand side. You can't see that, but just in looks like the first quarter of 2024, the MNAV was less than 1, and then there was a mad dash to go to buy it. I think principally because institutions that couldn't buy the Bitcoin ETF or Bitcoin directly, they would buy the stock instead, and so the MNAV got up to about 3, which is where it was in November 2024. And then as investment guidelines get adjusted and mandates gets changed, the demand for their stock came off a little bit, but of course they were still issuing a lot of stock because they kept issuing stock to buy more Bitcoin. And I remember seeing, I think it was on CNBC, that Jim Chanos said that he was long Bitcoin, short MicroStrategy, and that he had just taken that trade off, and proper time to take it off, because now the MNAV is at about 2% premium. So the value of the Bitcoin they have in their BIC is only about 2% more than or the market cap is only about 2% more than the Bitcoin they have there. So I think what that means is we're about to go into a period where MicroStrategy is no longer going to stock is going to underperform the price of Bitcoin, which it has. So I think that's the blue line. I think there's not. Is there? I guess. Oh yeah, the blue line is MicroStrategy stock. The orange line is BTC. So Bitcoin has kind of traded sideways since May of 2025, whereas starting in about July, MicroStrategy stock led on the downside, as they say, and I don't think that's going to go on.
What are your thoughts here? So I'm going to pull. I'm going to do a little screen share here once again. On my screen now, I actually have the price of Bitcoin. I should have done this logarithmically, probably. This is Bitcoin. This is what I want to have here. Let's see if I go like this. GPL. I'm going to do a logarithmic chart. I am going to make this maximum. No, I don't want monthly. I want weekly. So how far out can I go weekly? Let's just do a 10-year weekly. And let's take a look at, I'm going to get rid of these other moving averages for a moment.
Yes, that's it.
Because this is the chart that I was noticing that we're kind of just bumping along right here.
Yeah.
Right? And this seems like a kind of a critical threshold to me. You know, we have bounced off this level a couple of times or come close to it in here, going back for a couple of years. We're right there right now. Yep. So
nervous
the
time.
first thing I would say about strategy is, what do you think? Is it going to be this
Yeah.
hit and bounce, or is it going to be this
Um,
hit and break?
yeah. Well,
That's the real question.
yeah, it's a $64 question. The one piece of information that's come out is people that bought Bitcoin back when its price was less than $1,000 and bought it in size. People that examine what's going on the blockchain have
Hmm.
noticed that those guys are selling some of their position now.
There's some big whales who've been selling.
Yeah.
Yeah.
So
Hmm.
uh, interestingly that it hasn't really beaten down the price of Bitcoin. It seems like a lot because it peaked at 125 and now that we're just a little above 100. So let's call it a 20% drop. Um, and a lot of people were looking for a big fourth quarter, so they're frustrated. Um, but I don't know if it's going to hold that 50-day moving average or
Oops.
not. But one of the things that I'm confident in is the government is not going to cut the budget. They're not going to cut the deficit. The Federal
Hmm.
Reserve has basically said QT is over, and they're going to
Yeah.
stop letting assets roll off their balance sheet. And so we'll be locking in those that new price level.
Hmm.
And so we shouldn't expect prices for anything to go down in the years ahead and continue up. So there's still a tailwind, but it doesn't just because there's a bit of a tailwind. There's a big standard deviation around that tailwind, and so we can have a nice big shakeout. If you drew a line from the top of 2023 to the kind of the bottom of 2024, looks like $70 might be a decent support level. Or going all the
Hmm.
way back to 2021, draw a horizontal line at 70.
Yeah, I would say. Well, here's the thing.
That's
Yeah, so
50.
this is right. Yeah, this is 70 right
Yeah, so
here.
right somewhere's around there.
So yeah, what I was thinking was, uh, there was one notable exception, but actually, in some of these earlier breaks below this longer term average, for example, right here, it would have. You actually had a little bit of time to respond to the fact
Yeah.
that it fell definitively below that. Here you did not. Here it literally just basically you didn't have time. It in 10 days it just absolutely
Yep.
collapsed. So I don't think, but you can also see that the price action leading into that was not like the one we're exhibiting now.
Hmm.
It's closer to this. It is closer to this.
Hmm.
Here it broke below. But again, you had a little, it was quite definitively below, and it was not an absolute crisis. So my thinking is that with respect to strategy, this is kind of the critical level. If you're not making a determination today about whether you want to buy or sell, you probably have a little bit of time to see whether it gets definitively below that. But my guess is it's going to hold.
Yeah. No,
Um,
that's
that
what I've
that
been thinking as well. But if it does break, I think it can go as low as 70.
Yeah.
Has
So
been
the
my
other
thought.
thing, though, on the strategy part, though, and I'd just like to get your thoughts on this, which is that I actually, because strategy has taken on more debt as a part of their capital structure
Hmm.
recently, I no longer look at it as the market capitalization to the notional value of the outstanding
Yeah.
Bitcoin, but actually their enterprise
Yeah.
value. And I believe, what's their current holdings? I thought it was about 640,000.
Um,
I use that in the back of my head
yeah.
as the round
That's
number,
about,
which is about 66
yeah.
billion. Is that what you
I
know?
think so. Let me go. There's a website I can run to real quick if I can remember how to get there.
Okay.
Bitcoins. How many bitcoins? Uh,
So that gets them to, if we look at it
yeah,
on an
641,
enterprise
692.
641.
692.
692. We'll call it 103,500 times. It's about 66.5 billion bucks.
Mm-hmm.
So I'm looking at that versus an enterprise value of 82.4, let's call it.
Yeah.
So that gets them at about 1.24 times.
Yeah. Okay.
So to me, I was telling people that my thinking was that maybe that number gets out down to, 1.1. That I didn't mind the idea
Mm-hmm.
that I would pay 10% over, we'll call it the book value
Mm-hmm.
of the Bitcoin holdings to make a bullish bet on Strategy, banking on them being a little bit more. First of all, it's a slightly levered play,
Mm-hmm.
so I'm willing to, it's an equity risk, but with a little bit of upside leverage. And I anticipated that they would continue to try to be creative about whatever accretive purchases they could engage in. So that was kind of my logic that, maybe 1.1 times on an enterprise value basis, which is about a 10% discount to where we are right now
Mm-hmm.
on a relative value. So that would, if you're tracking Strategy versus, what do you think of that idea? Or do you think I'm being too greedy?
No, that's certainly one way to sort of box your risk and get an idea of what the worst case is. Because you know what, and you've seen this 1,000 times. Things start to go down a little bit wobbly, and then the bottom falls out because there's
Mm-hmm.
somebody that has a big position that just can't take the pain anymore, and so they hit the sell button, good and hard, and just they went out for no reason. One of the things that I wonder is where he's taking the business, let's say 5 years from now. What happened, if they started lending their Bitcoin and they could probably get 7 or 8%, if they lent their Bitcoin, that's, they could all of a sudden start making $6 billion of cash flow. And so I was my supposition. Now, I've never met Michael Saylor, never went to a conference and had a conversation with him or anything like that. So I have no inside information here, nothing but pure speculation. But what's kind of taking place here is he's creating some instruments for savers that are liquid, but instead of you going to the bank and saying, "Hey, I want to cash in my my security," he's you just sell it to somebody else. And so they have now there's 4 U.S. dollar-based preferred stocks outstanding, and they just issued one in Europe in euro terms.
Mm-hmm.
So they're creating. I don't know. Maybe is this thing like a CLO with a huge equity slug? What is where is this going? So it may be that they're going to create a new kind of financial institution when all of this is said and done. But again, I have no idea. Pure speculation.
Yeah, I mean, it's on the lending side. I mean, how how much risk is in that 7 to 8%?
Well,
by your estimation?
yeah, oftentimes when they do it, they over collateralize, and so they'll call the loan if the price starts to fall, and which is would get them in trouble. My guess is that there's not enough confidence in the technology where you can lend. And so that's probably why they're not doing anything like that, because there's all these.
If confidence in that increases, that to me is, I mean, it creates such support for Bitcoin at that point.
Yeah.
As confidence on the lending side increases, because then people are saying this is not, this is potentially an income producing asset. I can now actually take my Bitcoin and start earning.
Yeah.
And, that's immensely bullish, I would think.
Yeah, there's a number of lending platforms where people uh, will use their Bitcoin for collateral, and they're typically 50% or 100% over collateralized. Sort of like the same way you buy a stock. You want to buy $100 worth of stock, you got to have $50 worth of collateral. And so the lending
Hmm.
platforms that are doing this are kind of using that. And then if the price of Bitcoin falls to some level, just like with your stock portfolio, there could be a margin call. There could be a request for additional collateral, um, and that kind of thing. But these are all being done by software, and I think a lot of time and loans need to be made before people are 100% confident that they can't be hacked somehow. Like
Yeah.
if I had some regular run-of-the-mill Bitcoins instead of like an ETF like IBIT or something, um, I wouldn't put them
Might be a
at risk at
worthwhile
at a Dow.
exercise and might be a worthwhile exercise and experiment. Buy a Bitcoin and do this and see how it actually works out in practice.
Yeah. But
Um,
no, I did see
I
J.P.
mean,
Morgan now.
once one gets comfortable with the notion that you're gonna put $100,000 into a platform and say, okay, well, if this is not what I think it is,
Well,
uh-oh.
J.P. Morgan has come out and said that they will lend against Bitcoin as collateral. The IBIT, the
Uh-huh.
ETFs, they will lend against the ETFs. So a step is moving forward. At least that's what I
Yeah.
read. I don't. It wasn't an official letterhead of J.P. Morgan. It was something, because I read a ton of stuff, and that's one of the things I saw. And
So before we jump, actually, Tucker the dog brought up, and I think we flashed this on screen, but Monday Morning Quarterback was asking about CDS. I haven't looked at this yet. I was just trying to look at it on the back here. Hellbore Capital has opened to DataGrapple its credit derivatives database containing price information on credit default swaps on more than 600 companies and credit derivative
mhm.
indices.
Okay, cool.
So that might be an interesting one. Well, we have chewed up more than an hour. As always, I enjoy these conversations and certainly some things to think about. I really am interested, I have to say, because we're coming into that time of year. We should talk about the transports. I think that'll be an interesting conversation for next week. Um, Many people who watch will know that FedEx is my nemesis. This is just one of those companies that I've never traded it well for whatever reason. Had some pretty gruesome issues. It actually was the stock when our auto hedger, when I was at Canner, our auto hedger went nuts,
Yeah.
and and it printed a big block of stock just inside the obvious error rule, of course, on the big board, so I couldn't get the trade down.
Mm.
That was a six-figure hit in seconds.
Wow.
So yeah, I think it was like $140,000 if I.
That hurts.
Yeah, it was one of these things where I had the screens and all of a sudden I saw FedEx just do this really strange print and I was like, what the heck was that? Because we had positions in FedEx, obviously, among many other stocks. And then I was thinking, well, that was really strange. And then I thought, oh my God, please tell me that wasn't us. Something we were doing.
Hmm.
And I was looking at the execution tiles, and sure enough, so what had happened was we were working big orders in the options, and we had an auto hedger program so that when our deltas got to a certain point, it would look to hedge them. Now, in general, we were executing our options in slow pieces really steadily, but we had what was called an iceberg order on the option side, which meant that I was only working like a 50 lot that you could see, but the truth was we were actually working more than 1,000 calls,
Yeah.
and with a relatively high delta, and there was the circuit breaker in the auto hedger was not configured properly, so all of a sudden tick on huge deltas because the call's executed, and the auto hedgers are like, okay, go to work on the stock.
Yep.
With impunity. Horrible. Horrible.
It happens.
Anyway, it does happen. The painful lessons we learn. Okay, well, for everybody who tuned in, either now or who watches this in recording, we both thank you very much for your time and attention and listening into our conversations. Comment, and maybe we can address topics that are of interest to you in the next office hours, and that is, after all, the whole purpose of this. You have access to Professor Mark Guthner in these sessions, so if you have questions, ask them, and hopefully we'll answer them in a future video. And in the meantime, I think what we hope to talk about next week will indeed be the transports, because there's a lot of things going on. It's that time of year. We have seen consumer stresses. We've seen freight rates. The MD-11 grounding for both UPS and FedEx is going to have implications. What does that do to rail and road freight? There are a lot of interesting things that we could potentially touch on, and so we'll do that next week.
Yep.
Same time, same channel. We'll see you then. Thanks for watching.